It's been a long, hard slog in getting there, but gold, priced in dollars, is now at around the 2000 level, not too far away from those record highs we saw not too many months ago. But the big question is whether or not we're going to be able to get through this level and then start to breathe fresh air above that key 2000 psychologically important level. Let's take a look at the technicals around this now with a regular guest here on IGTV. It's Ron William from RW Advisory. Ron, welcome. It's an interesting point. You've done some research around this, I know, and when we were talking about getting this interview together, you thought you could come up with some charts to explain what's going on. Let's start, if we can, with you asking just to set the scene, because clearly this is a long, ongoing story.
Absolutely, and as everyone will be aware, the gold retest of $2,000 glass ceiling is here again, and that is following a previous retest that we saw in March 2022 and August 2020, which is what we see on the opening chart. What's interesting is that it also extends a 25% gain from the trend extremes, while also generating the highest monthly and quarterly close in history. So certainly headline grabbing gold price action. If we take a step back and look at what happened in the month previous, that happened in the latest upswing was actually following the March panic, igniting a renewed flight to safety. So certainly that remains in the back scene for now. But when we look at gold across asset, you can just see the bottom right-hand chart. Gold outshines world equities, notably US and China, plus other cross-asset proxies. Yet in the short term, ranking scores that you see there on the diagram, it is unwinding, having become overbought.
So, Ron, that's taking a look at gold in dollars. But as I said at the top, it is possible to price gold in other currencies. What's happening in other currencies when you look at the gold price?
Broad strength of gold, and certainly this reemphasizes that the rising tide lifts all boats, not just gold in dollar terms, which I know is the proxy that we're all looking at, especially given that it is retesting that $2,000 glass ceiling. What's interesting is that A, you get the broad strength of gold versus other currencies, but B, you can see that gold in dollar terms is the underperformer of the basket. So you see the blue line there in figure 1, left side, is actually at the lowest point in the chart, whereas on the highest you have gold versus South Africa Rand, Japanese yen. Some of this is FX case-specific volatility, but across the board, gold is outperforming other currencies and in many situations at all-time highs. So this is a strong gold story, and it really is more about how you trade it. And what's interesting is if we look at the chart inserts on the right, gold is onside gold. Sorry, the dollar is onside gold this year. So it is actually supporting the upswing in gold, given that dollar is down 5% year to date. And big picture macro, this continues to spell the fiat debasement story, particularly as central bank policy continues to balloon debt. We have the debt ceiling meeting coming up in the US. And as you can see there, figure 3, history teaches us that fiat debasement is what happens overall versus the gold, and that will continue to consider more investors.
This is an interesting point, isn't it? Because this whole point about gold and this debasement of currencies, and gold is a good place to hide. This, of course, is one of the reasons as to why we've seen so much around Bitcoin recently and the success that Bitcoin has had, because it enables us to get exposure to an area of the market which doesn't get debased. How do you deal with the Bitcoin gold conundrum?
It certainly has attracted lots of attention and also flows. The best work I've seen on this is from industry colleague Charlie Morris, that's designed an index called Bold, which is a combination of Bitcoin and gold. It's an 80-20 split. So with the greater part, 80% on the gold side. That, in my mind, is one of the better ways to consider the combination of the two and rotate in terms of performance, but also how they both offer long-term returns.
Okay, let's get back to the charts and go with the next chart, which looks at the long-term chart for gold, because it's one thing looking at the 2000 level, but I think in the terms of long-term performance, what are your thoughts on where gold has come from?
Yes, so in terms of long-term performance has been positive, and partly in recent times because of central bank optimism in gold. So our next chart themed sovereign risk as the driver for this highlights that central bank demand and purchases of gold, although it's at the margin in terms of how it impacts gold, is at a generational high. I think it's a 55-year extreme. So it's up 18% last year. You can see that on figure 1. And what's very interesting about that is it's also being supported by sovereign risk. You can see the top right chart, figure 2, showing that concern from money printing, sovereign risk. This also occurred in 2008 GFC, 2011 debt crisis, and to a lesser degree in 2020 COVID. It's also a result of central banks underwriting all bank deposits. Again, going back to that March banking crisis event, it may have been partly solved now, but at a price, and we're starting to see the issues of that in diversification into gold on the central bank level. The last chart there, very interesting and timely, showing that central banks around the world, primarily China, are choosing gold over US Treasury. So this is part of the diversification play with the geopolitical risks that started from last year vis-a-vis Russia, Ukraine, and the sanctions that followed. There is a new shift now in policy, and that is now diversifying away from US dollar and US Treasuries, and the next place to hedge for many central banks is gold. So again, this doesn't create trends, but it does at the margin support the gold surge.
Okay, let's go back then to where we are today and talk a little bit more about where you see gold going. You mentioned the fact that gold and the dollar work with this inverse correlation. I notice actually as we speak, we're looking as though we could well end up with the first week in 7 where we got the dollar rebounding. And if you take these correlations, I have to ask you whether or not the short term we are likely to see a little bit of a pullback in the price of gold before a further acceleration. What is your view of the here and now?
Gold short term down here and now, pressured by a triple whammy bearish signal. So that's number 1, price exhaustion, 2, momentum divergence, and 3, cycles signaling downside into Q2. And that is further supported by the dollar rebound that you just highlighted. So while the dollar did assist on the way up to $2,000 gold in dollar at that key level, it will also add headwinds on the way down. Despite gold being broadly strong, it will also influence at the margin. So we can see that in the chart there. We also had multiple reversal signals as gold traded into 2000. So from a data point of view, we hit the level, but from a behavioral perspective, we did it reluctantly, and there was some resistance along the way. Looking ahead, it's important to keep in mind that while we might have a short-term tactical opportunity on gold, medium to long-term investors should think about this as a buy on the dip opportunity. And certainly that's what is being reflected in the sentiment data. If you look at the bottom right chart insert figure 3, investors are accumulating, and this is what you want to see for additional elevation in gold into the future.
Just wrapping it all together, what is the longer term price target now then?
Yes, for those looking ahead, wanting to buy on the dip on this next setback opportunity, it's good to look at gold in inflation adjusted terms, and that at least gives us more of a true benchmark measure. When doing so, we see that there's a target at 2,800, which was the old high back in 1980. That's the first point. In addition to that, we should keep in mind a double hedge risk of both macro and geopolitical. So macro in terms of inflation, and geopolitics in terms of exactly that, tensions of what happened in 1980. We had the Soviet Afghanistan incursion, Iranian Revolution, high inflation, 1973, 74, Yom Kippur, oil shock, equity crash, and stagflation. And while history doesn't have to repeat, it can certainly rhyme. Certainly with what's happened last year, Russia, Ukraine, and potentially more tensions ahead, gold continues to be a hedge both for long-term inflation and just general geopolitical risk and any other uncertainty. It is the place for safety. And do notice that that commodities per se, gold in particular, can spike. And that's what the historical pattern shows us. Back in 1980, it did jump by $700 in just 1 week. While that's difficult to trade, it is still something to keep in the back of our mind in terms of a potential scenario for gold.
Yeah, interesting. Look, Ron, thanks very much indeed for joining us. It gives an insight into where we are in terms of some of the technicals around the gold price and some of the possibilities in the longer term. That's Ron William from RW Advisory. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.